Welcome. Today we're diving into a crucial concept in Indian taxation, residential status and its impact on tax liability. The Income Tax Act doesn't just look at where you earn your income, it also considers where you live, or more specifically, your residential status in India during the previous year. This status determines how much of your global income is taxable in India. Though you're an individual, a Hindu undivided family, a firm, or a company, your tax obligations can change dramatically based on your residential status. In this video, we'll break down the categories, rules, and real-life examples to help you understand how residential status shapes your tax liability. Let's start by understanding why this status is so important for every taxpayer. Now let's look at how the Income Tax Act classifies taxpayers based on residential status. There are three main categories: resident and ordinarily resident, not ordinarily resident, and non-resident. Individuals and Hindu undivided families HUFs can fall in any of these three, while firms, companies, and other entities are either resident or non-resident. The rules for determining status differ for each group. For individuals, it's about the number of days spent in India and past residency history. For HUFs, it depends on where the control and management are located and the status of the karta. Companies are judged by their place of effective management, while firms and associations look at where their affairs are managed. These distinctions are critical, as they directly affect the scope of income that's taxable in India. Let's focus on individuals. The Income Tax Act sets out specific conditions. If you're in India for 182 days or more during the previous year, or for 60 days in that year plus 365 days over the preceding 4 years, you're considered a resident. There are exceptions for Indian citizens leaving for work or visiting India, where the 182-day rule applies. Once residency is established, further conditions decide if you're ordinarily resident or not ordinarily resident based on your residency in the past 10 years and total days spent in India over the last 7 years. If neither basic condition is met, you're a non-resident. These rules ensure that your tax liability matches your actual connection to India. Real-life examples like Mr. Anil or Mr. Mayank show how these rules work in practice. Once residential status is set, the scope of taxable income comes into play. Residents and ordinarily residents are taxed on their global income, everything earned, received, or accrued, whether in India or abroad. Not ordinarily residents are taxed on income received or accrued in India, plus foreign income from businesses controlled in India. Non-residents are taxed only on income received or accrued in India. This means your tax bill can look very different depending on your status. For example, salary received in India for work done abroad is taxable for all, but foreign property income is only taxed for residents. Understanding these distinctions helps you plan your finances and avoid surprises at tax time. Wrap up: residential status is the cornerstone of tax liability in India. It's not about citizenship, but about where you live and manage your affairs. Individuals and HUFs can be resident, not ordinarily resident, or non-resident, while firms and companies are either resident or non-resident. The scope of taxable income expands with closer ties to India. Knowing your status helps you comply with the law and optimize your tax planning. Remember, the rules are detailed, but understanding the basics can save you from costly mistakes. Stay informed and consult a tax professional if you're unsure about your status or obligations.